Good morning, ladies and gentlemen. A very strong, aggressive and forward-looking policy by the Reserve Bank of India. You've had three major rate cuts as far as the repo is concerned. There are changes in growth and inflation outlook, and of course, fresh liquidity measures have been introduced. We are joined by three of the finest brains on the macro front as far as the market is concerned. Aditi Nayar joins us. We have Rumki Majumdar and we have Subramaniam Sharma discussing the policy. Coming to you, Aditi, first, two or three major points you think the governor made during the speech which caught your attention.
Thank you so much. Well, certainly, this was a very interesting policy with the surprise upside in the GDP data that we got last week. We had actually changed our call from a cut to a pause. So, that notwithstanding, we did end up with a cut today. I think one very interesting point that was made towards the end of the speech was that benign inflation is allowing us to remain growth supportive. So I think that's really one of the key takeaways that I saw. In terms of the forecast changes, mostly along expected lines, the inflation forecast for this year has been brought down to 2%. We're a little bit higher than that at about 2.1 or 2.2. And on the growth side, they've increased the growth forecast to 7.3%, and we're actually just a little higher than that at 7.4%. But broadly along expected lines, I think the market will be quite happy to get the assurance on the OMO today, right, and the rupee dollar swap as well. My sense is that this is probably going to give a lot more comfort in terms of yields and the forward-looking outlook for
right,
yield, given the fact that subsequent policy space to cut rates is probably really limited now.
Right. Rumki Majumdar, economist at Deloitte, joins us. A very good morning to you, Rumki. Your first thoughts on the policy?
Yeah. As we were also expecting a pause this quarter because of the high growth and low inflation. But then I think what has prompted the RBI to go for a rate cut is the fact that inflation is low as of now. And even despite the last 1% rate policy rate cut, the credit growth has not picked up. So that is something which may have prompted the RBI to go for further rate cuts, so that can help the credit to pick up, because that is the key, and it should be a lead indicator for the future quarters' expenses and consumption spending. So that has to go up. Right now it is around 10%. It has to go up at least 15-16% to ensure that the growth that we have seen in the last 3 quarters sustains over the next few quarters as well. I think it is more of a preemptive move to make sure that growth remains sustainable going forward.
Okay. We are now joined by Mr. Subramaniam Sharma, Founder Director at Greenback Advisory Services Private Limited. A very good morning to you, Mr. Sharma. I have also got ready a 5-minute chart of the rupee for you. Sir, what do you think is the reaction of the rupee as far as the RBI governor's speech is concerned? He wasn't much too concerned about the rupee breaching 90. What are your thoughts?
I think the rupee has seen a slight weakness post the US policy on the trade agreement with India, and that was been the biggest factor for the rupee depreciation. And also liquidity in the FI pulling up big money out of the system was one of the reasons for the rupee weakness. And RBI also seemed to be okay to pull out their intervention. They toned down their intervention, and that's how the rupee's pace of movement from that 89.50 and break of 90 faster than what normally would have happened. So I think RBI would have been looking at the inflation factor also, that in inflation being at an all-time historic low, and also growth has been taking care. They were okay for the rupee to partly depreciate because export has been falling, and we saw trade deficit widen in October, and to give some boost to the export and possibly a comfort, the RBI may be okay for the rupee to depreciate. And I think the depreciation is okay considering the other parameters of growth, domestic strong consumption, and other faster GDP growth and all. So I think RBI let it depreciate, but as they will keep a watch on it, any sharp depreciation maybe also intervene, and we saw that yesterday after the rupee weakened up to 90.40 level, we saw pullback, and today it moved below the 90 and tested a low, high of 89.80. So broadly, I think that this two-way movement is giving a comfort to the market also, that rupee is not going to a unilateral depreciation, and smaller depreciation is okay considering other positive parameters.
Right. I'll stick with you, Mr. Subramaniam. I need to know what is your gut feel about the rupee. Where do you see it over the next 6 months?
I think rupee should see a decent correction. In fact, this weakness has been purely driven by technical factors. Fundamental factors are very strong. We have seen a strong consumption, lower inflation, higher GDP growth, which are technically supportive of the dollar, rupee or a currency. But unfortunately, we have seen the negativity due to the US trade agreement not being signed, and the higher tariff, which is yet not reduced, and also a strong sell-off by FIs, and they have pulled out almost $16 billion from the system. So it is purely a liquidity-driven weakness where demand has been more than supply, and added to that, we are at the fag end of the year where the activity will be little muted and FIs may not bring in money now. So we may see the rupee to trade in the range between the 89.80, 89.50 to 90.50 levels in December. But come January, as we get closer to the budget, and also by that time, I think the US trade agreement would be signed. Some positive news on the tariff may come in, and also the crude has been fortunately lower. India continues to enjoy a lower crude price, and they have been able to import the crude at lower price. So all these are little positives which may come in towards January, February, and I won't be surprised if the rupee correct by at least 2%. And to my this thing, I think 88.50, 88 to 88.50 could be a level could be seen as we go ahead in the new year.
Okay, Rumki will not allow me to ask her about the Indo-US trade deal, but I'm sure, Rumki, you have a view on the rupee and the RBI's steps or the lack of them to sort of, provide a holding ground for our currency. Your view on the rupee?
No, I would be happy to have a view on the rupee as well. See, the thing is, right now, RBI is taking a stance of not to intervene in the market because a currency depreciation against the dollar helps India deal with the crisis of higher tariff uncertainties on its exports. Right? So it definitely helps in cushioning of the higher prices that we are kind of facing in the US. And given the fact that, as rightly pointed, the oil prices are more or less stable, we are importing less, so the higher depreciation is not going to bite us in terms of higher input as such. So that way, I think the RBI is taking that advantage and not letting the currency not appreciate against the dollar, because the dollar value is falling as such. But if you see dollar currency value against the EU and the UK currency, the pound, that has been very stable. It depreciated very fast last year, but then it has been very stable since. It's only against the dollar it is depreciating. So that way, I think INR is doing pretty well. It's only against the dollar, and it helps in a way because it cushions our exports. So I think RBI is doing a quite good job of balancing the rupee.
Okay, so that's a very well-balanced view coming in on the rupee. Let's get Aditi's thought here. Aditi, the absence of the Indo-US trade deal, continued FII selling, and the fact that the markets really are not going anywhere. How do you see the rupee over the next 3 months or so, a short-term outlook?
Yeah, I think definitely for the rupee, a lot of factors that will have an impact. First of all, in terms of not just the US trade deal on goods, but also if there is anything that comes through on the services side, that's something that we'll be watching out for. Secondly, when we look at the kind of sectors that have been impacted, some sectors would have been able to tide over this period because they're very well entrenched in the supply chains, and therefore they are able to hold their ground in terms of the negotiation with the buyers. For other sectors like textiles, for instance, winter tends to be a smaller season, so they would be really hoping that there will be some resolution on the tariff side, before the negotiations for the summer season start, for instance. So I think it's going to be a mixed bag in terms of how industry is going to react. And the rupee, if I remember correctly, obviously I'm not an active participant at all in the currency market. But if my memory serves me right, typically when the year is ending and the trades are very thin, they tend to be outsized responses of the rupee to even small news flow which is there. And the importer buying can have an impact. So I think maybe over the next month, particularly, there could be a little extra volatility before things settle down in Q4.
Okay, what we'll do, ladies and gentlemen, is get it straight from the horse's mouth as to why there was a repo rate cut. Here's RBI Governor Mr. Malhotra talking about that decision.
I will now come to the major decisions of the MPC and the RBI. The MPC met on the 3rd, 4th and 5th of December to deliberate and decide on the policy repo rate. After a detailed assessment of the evolving macroeconomic conditions and the outlook, the MPC voted unanimously to reduce the policy repo rate by 25 basis points to 5.25% with immediate effect. I repeat, the MPC voted unanimously to reduce the policy repo rate by 25 basis points to 5.25% with immediate effect. Consequently, the STF rate under the LAF shall stand adjusted to 5% and the MSF and bank rate to 5.5%. The MPC also decided to continue with the neutral stance.
Well, those were the three major policy decisions that the MPC and the governor took to add further liquidity and reduce borrowing costs further. Mr. Sharma, coming to the two steps of liquidity, OMO of 1 lakh crores and the rupee dollar swap of $5 billion over the next 3 years. How do you see these two? Were they necessary to for the call money market for these two steps to be taken?
Yeah, there was some liquidity crunch in the market, and these two actions will definitely boost the liquidity because 1 lakh crore into the system coupled with the lower interest rate and dollar rupee swap will infuse the huge liquidity, and with the lower interest rate, I think the local consumption will go up and that will keep the economy's growth. So I think it was the right direction they did, having a rate cut coupled with the liquidity being infused is a good combination, and I think that itself will give a confidence to the economy, and rupees movement will be purely driven by the demand, supply and the flow related movement, but fundamentals are going to eventually determine the course of the economy.
Okay, ladies and gentlemen, post 1 hour of the policy, the market is now in fine shape. Nifty days high, a triple century on the bank Nifty, and it's the IT stocks that are taking it away. 500 points higher on the Nifty IT index. Coming to you, Roomkey, when you look at the macro balance sheet of the country at this point of time, the end of 2025, a couple of thoughts how 2025 panned, and what are you looking forward to in 2026 Q1 calendar?
So since we are expecting a very strong 3 quarters, the Q1 could be a little slowdown in case India-US trade deal doesn't come through. We have been waiting for this with bated breath. If it comes through this quarter, then I think the Q1 will be very good. But if not, then I think the exports and the trade would probably be much more softer. But that said, in general, we expect the first quarter of 2026, the calendar quarter, that is Jan to March, we expect it to be around 6.1 to 6.4% growth, barring the trade deal. If the trade deal comes through, then it could be a couple of point percentage higher.
Fair point. Aditi, to you, is there anything that's missing in India's macro balance sheet that you would want the RBI to correct over the next 2 odd meetings? What are your thoughts for the next 2 MPCs?
Look, I think the next couple of MPCs are going to be quite interestingly poised. The next one will be right after the budget, and it will be right before we get the new GDP series on the new base. The CPI series was also getting revamped, and there's going to be a whole host of new data for the MPC to start looking at in its April meeting. So possibly some numbers may actually end up looking a little different on the new series. We don't quite know. For instance, we'll get a new IIP as well, and on the IIP side, because there's sampling which is done, moving to a new base may give us very different outcomes from what we're getting on a rather old base right now. But on the GDP series, because it's already bringing in a lot of other data sets which are relatively, I would call them current. Like for instance, it is drawing from the MCA 21 data on listed companies, for instance. So you're getting real-time data on the companies, revenues and profits. So perhaps there, I don't expect there to be so much of a change. I think it's not going to be as drastic as for series like the IIP. But the CPI also we're going to get an updated base. So I think the MPC will have quite a lot of sort of new data to look at and try and make sense of what FY27 will look like, especially in the April meeting.
Okay, ladies and gentlemen, let's just take a detour in the market, and predictably sectors that are linked to lower borrowing costs are in top shape. Look at how autos are performing. M&M fresh record high. Hero Motors, there's absolutely no stopping it. The PSU banking outfit in top shape. Gains all around because of fresh liquidity being injected into the system, and of course the rate cuts. To you, Rumki, there was this widespread talk about how the GDP number came about last Friday, exactly a week ago, and for whatever reasons the market sold off given the inflation number that came in and other sets of issues with the government and the IMF. How are you looking at the GDP number? Do you take comfort from 8.2? Is that how the economy is shaping up?
It is. I mean, nobody expected a growth of 8.2 in the second quarter of the fiscal year. So it was a big surprise, and it clearly shows that there is a lot of underlying strength in the domestic demand, even though exports didn't perform as much. So that's probably one of the reasons why the government is now focusing on double downing on the domestic demand as much as possible. We are also expecting around 8.5% for the third quarter. So if that be the case for 3 straight quarters, then because all the high frequency numbers, if you look at, they are pretty much topping the charts. If you look at the two-wheeler sale, auto sales, or the retail sales, the RAIs, all the numbers are pretty good. And of course, November might be muted, but again, December is a year end, which again is a time for consumers to spend. So if this quarter remains very strong, then even if the fourth quarter is a little muted, the overall year growth will be very high. So we are looking at around 7.5 to 7.8% growth in this fiscal year. Could be even higher, but and I don't mind saying that either. But yeah, going forward, this next year, FY27 could be a little muted because we already will be starting with a high base in case the growth continues to be on the stronger footing the next 2 quarters.
Well, the markets seem to be listening to you. Every passing minute we have an intraday high on the Nifty. Mr. Sharma, I'll come last to you, but one final question to Aditi. 8.2, a lot of kerfuffle between the IMF and the government as far as the quality of GDP data is concerned. What's your take, Aditi?
No, I'm not going to get into that. I think I'll take the question you asked, Rumki, because I have a slightly different view of how Q3 is panning out. I think there is a little bit of a disconnect between how the consumption numbers are looking for October and how the production numbers are looking for October. So because we had the festive season solidly in the month of October and it was earlier than last year, YOY growth numbers on anything that is to do with the retail side is looking fabulous, right? But when we look at the production side, things like the IIP number, that's not looking good. And even the GST number, which is which was reported on December 1 is for the collections in November, which were for transactions in October. There again, the growth was not very healthy. Of course, we had a lot of festive season holidays, so production was shut. And therefore, there is this disconnect which is opened up. And I think it's fundamental for us to look at the October-November numbers, the averages, to really get a sense of how this quarter is going to move. I think that there are going to be some sectors in which we are going to get a little bit of a breather after these runaway numbers in October. So I'm a little circumspect. I don't think that the entire quarter is going to turn out to be as good as October was on the retail side. Couple of things just to keep in mind as we move from H1 to H2. There are very solid base effects on the GDP side in Q3 and Q4. Last year, the pace of growth had gone up by like practically 100 basis points each between Q2 and Q3 and Q3 and Q4. Secondly, the trade side, we've all talked about it. The good news from the upfronting of exports to the US is now all in the past, and what lies ahead is either the pain or the trade deal, as Runki has been saying. And thirdly, if we look at the government capital expenditure side, government has done a lot of front loading of its capital expenditure in the first half, and what's left for the second half, the headroom is actually 15% lower than the spending which was done last year. So here now, unless there is some reallocation of outlays towards capital expenditure, we could be looking at a third headwind. So I do think that H2 is going to look materially different from H1, and the average that we have for now is 7.4% for the full year.
Wonderful. Mr. Sharma, thank you for your patience. My final question for the show is directed at you. Look at the India macro balance sheet. We have adequate foreign reserves. There are very, very strong tailwinds which are boosting at least equity markets from the macro side. What do you think will be the stance of the government in the forthcoming budget as far as the macro balance sheet is concerned? Which side will the finance minister tilt? Adding more capacity on the infrastructure side, or providing more benefit to the consumer on the ground?
I think they have been balancing. I think more effort should be put towards the infrastructure side, because that is the biggest driver of the economy. Of course, they have been giving benefits on the spending side, the GST cuts, the liquidity, the rate cut, all those are going to definitely drive the economy. But it has to be matched with a matching capacity and supply side. So I think infrastructure growth and capital expenditure should be the bigger driver, and that could make the overall growth, more visible and more sustainable.
Right. With that a very hopeful note, Aditi Nayar, Rumki Majumdar, and Subramaniam Sharma, thank you so much for your time. What a wonderful discussion this was.
Thank you.
That, ladies and gentlemen, was a three-expert take on what the RBI governor did to boost liquidity, to offer lower interest rates, and to further kickstart growth beyond 8.2% in Asia's and the world's fastest growing economy. Thank you for watching. What a pleasure it was.